Okay, everybody, I'd like to introduce our next presentation here at the Planet MicroCap Showcase Vancouver, actually our final company presentation here at the event. And I'm very pleased to introduce Richard Kellum from DATA Communications Management to close us out here. Richard, take it away.
Thanks, Robert. Good afternoon, everyone. And I know we've got some people online that may be overseas, so good evening or good morning, wherever you are in the world. I'm here to talk about this incredible company called DATA Communications Management. I actually joined the company 2.5 years ago, almost exactly 2.5 years to the day, after about 37 years in the consumer goods world, working for large multinationals. Longest and largest company I worked for was Mars Incorporated, who you may know, a $45 billion private company, and I ran a bunch of different businesses in different markets around the world for them. So real happy to be a part of DCM and tell you the DCM story today. Obviously, I will be making some forward-looking statements, so maybe advised on that. And then the official disclaimer, exactly. So here's what I want to achieve in the next 20-25 minutes, a little bit about who we are, what we do. We had a very sizable acquisition in April of this year. We call it Moore Canada Corp, but we actually bought the Canadian division of a company called R.R. Donnelley. Okay, so the shares were held in a company called Moore Canada Corp. So I will refer to it as Moore Canada Corp, but it was an acquisition of the Canadian division of a multi-billion-dollar organization. And I'll talk in detail. Then I'll talk to you a little bit about how we're performing on our bigger and better strategy. So who is DCM and what we do? We help clients simplify complex marketing, communication, and operations workflows. I'll tell you a little bit more detail on that in a second. We work with large enterprises. So we are not a small and medium-sized business operator. We work with large enterprises. So the bigger the company, the more complexity, the more value we bring. We're working with north of 75% of all large enterprises in Canada. You'll see our client list in a minute. We also do a ton of work for large government agencies. So think of CRA as one of our clients. A lot of complexity in those large government agencies. We've been around for north of 60 years, 64, 65 years. So we're well known in Canada. Very well-known organization, and we're pretty significant. Just north of $530 million in revenue, and again, about 95% of our revenue is generated in the Canadian marketplace. So we're a sizable player in that marketing workflow and communication printing area. A little bit about what we do. I don't plan to unpack this entire slide, but we are in the print and digital communication space. We do commercial print. We do a lot of business communication. We do a lot of labeling, label production. We do a lot of direct mail. And when I say direct mail, personalized direct mail. We don't do any non-personalized direct mail. So think of if you get a pre-authorized credit card direct mail piece delivered to your door. Hey, Richard, you're pre-authorized for $30,000 for a Bank of Montreal Super Elite card. That's the type of work we do in the direct mail space, okay, as an example. So a lot of diversification. Majority of our revenue actually comes from that seamless print and digital communications. I'm going to talk a little bit about some of the technology-enabled solutions and how we deliver technology through to clients and how we optimize that workflow with technology. And then we do have a lot of integration from a design, a strategy, and communication perspective as well. Real kind of simple slide here. The more complexity a client has, the more value we can bring to the client. So think of workflow for us is high SKU, low volume workflow versus low SKU, high volume. Low SKU, high volume, anybody can do. That's a race to the bottom. That margin pool or that profit pool is not nearly as attractive as where you've got a lot of complexity in communication workflow. So the example I gave you of a highly personalized direct mail communication, where you may have 4 or 5 personal fields that need to be included in a piece of communication, not everybody can do that. Only few people can do that, which means you can obviously drive margin. Okay, so we like to say we eat complexity for breakfast. The more complex a client, more value we can bring. Obviously, it's mutual value, the more value we can create as a company. That's a quick look at our client list. We work across 8 key verticals. Pretty sizable in the transportation area, very big in FI. We'll work with all the major tier 1 banks, sizable business in healthcare, retail, emerging markets, consumer health, energy, and QSR. Different things for different verticals. And I'll give you a few examples. I talked about direct mail. We do a lot for private wealth and private wealth advisors, helping them with communication, bespoke or personalized communication. On the healthcare side, we do a lot around PPI, so positive patient ID. When you walk into a hospital and you get a bracelet, it's got a piece of paper with a code on. We provide that entire kind of ecosystem. The consumable, the paper, we buy the bracelets and resell them. The scanners and the printers, we buy and resell those and maintain them. So as an example, any forms or labels you see in a hospital, likely we have produced those forms or labels. Okay, so a lot of different examples. There's not a single client, by the way, that is more than 6% of revenue. So a lot of diversification between verticals and between clients and between solutions that we bring to those clients. And that's what I love about this business is the diversification and the clients that we work with. We've got 14 manufacturing facilities across Canada, and you'll see in a slide coming up with the acquisition, we will be closing 4 of them. We announced 2 closures in July, and we announced 2 closures this morning before we started business here in Vancouver. So we will be consolidating that network to drive efficiencies and drive synergies. A little bit on the technology side, and I don't plan to unpack this entire slide, but if we look at this DCM Flex workflow automation and order fulfillment, about 35% of that $530 million in revenue is what we call tech-enabled. So think of Amazon is tech-enabling supply chain, tech-enabling flow, e-commerce. We tech-enable that whole supply chain for our communication and workflow optimization. So if you walk into I won't tell you the name of the company, but if you walk into one of the large FIs in Canada with 12 or 1,300 branches across Canada, anything that's in that branch, we would have touched, we would have printed, and we would have managed the whole physical flow. So a branch administrator goes onto the platform, orders what they need, we print. A lot of it is print on demand. We then kit, fulfill, deliver, and then it's managed through the administrator at the branch. As one example, do the same thing in retail, same thing in QSR. So a lot of tech-enabled workflow automation. Again, 35% of our revenue starts with technology, maybe ends up in a physical product. And we're starting to monetize that. Historically, we used to build a lot of that into the cost to print. We're starting to pull that out and create monetization around that as well. We do quite a bit in the marketing workflow area. Don't plan to talk too much detail on that. Personalized video. The example I gave you of a pre-authorized credit card, we now have the ability to do that in video at scale. So instead of getting a printed piece of mail through your door, you would get an email, click, and it would play a little video with your name and what you've been approved for, and a little click through to be able to go and fulfill that. So quite a lot of active clients on our personal video platform. Omnichannel is understanding the physical attributes of every single branch or every single store for clients, and then managing the communication for the attributes of that branch, of that store, of that restaurant. So we do a lot of that for several clients, and that's all automated and optimized with the platform. And then up here, Assemble is digital asset management. We are practitioners. We touch literally tens of thousands of digital assets every single day. And we also offer the asset management service through to clients. We've got several clients that we're actively using digital technologies to support those assets. Okay, it's a sizable category that we play to. The marketing and advertising services market in Canada is a $68 billion market. Print and marketing media is about $22 billion. And if you look at the print space, and we just sort of focus in on print. It's a $10 billion market, depending on what data you look at. Some will say it's declining by 1 or 2%. Some will say it's growing by 1 or 2%. So call it flat. It's a $10 billion market. We're $530 million of a $10 billion market. So lots of opportunities for expansion in this market in Canada. So I want to talk about the acquisition of Moore Canada Corp, or the acquisition of R.R. Donnelley Canada, because it was a recent acquisition. We closed the deal on April 24th of 2023, so a few months ago. We paid $135 million for this Canadian division, and I want you to think of this as $100 million roughly for the business and $30 million for real estate that came with the transaction. And our plan is to sell that real estate. In fact, we've already sold one site for net proceeds of $24 million, and we will sell the other 2 sites very shortly. Okay? So $100 million for the business. We paid 4.5 times EBITDA for the business, and we'll talk about where we're going to create a lot of value on this transaction. And of course, we're working to deleverage very quickly. I'm going to talk that in a slide coming up. Acquisition rationale was very clear. We bought out one of our largest competitors in the marketplace. So lots of opportunity for expanded product offerings, superior services. We continue to dial up our execution capabilities and great client leadership. And we bought, essentially, we went from 250 enterprise clients to 400 enterprise clients. Okay. Now, a quick look at the scale. If you look at the blue bar, the dark blue bar on the bottom, 21 and 22 revenue, you can see that the revenue for DCM as a standalone business went from $235 million to $273 million or $274 million in 2022 in that 1 year. So organically, that's all organic growth. We grew at 16.4%. When we add, from a pro forma basis, the acquisition of R.R. Donnelley, or MCC, Moore Canada Corp, onto that, our revenue goes to $530.6 million. And I'll get a few more details on that in a minute. So good, solid growth from an organic standpoint in 2022. We'll talk about where we are in 2023. You can see that always good news when your gross profit is growing faster than your revenue. That means your gross margin is improving. So we had very good gross margin improvements last year and have had for a number of years. And you can see that our EBITDA had a very strong performance as well. Okay, so moving from $274 million in revenue with the acquisition to $530, moving from $83 million in gross profit to $135 in total, and obviously moving from $41 million in EBITDA to $65 million in EBITDA. Now, for folks that are paying close attention to this slide, you can obviously see that light blue bar on the top, if you did a quick calculation, the gross margin is lower on the acquired company than the DCM legacy company. And that was one of the things that was very attractive about this deal. You'll see in a minute the gross margin for DCM is 31%, and the gross margin for Moore Canada Corp, their Canadian division, was 20%. Okay, so the opportunity is to grow that gross margin, and we've already got plans to improve that considerably, as you'll see in a slide ahead here. From a integration standpoint, we were certainly well prepared. I had done several deals in the past in my prior world. 4 areas of synergies: operation, organization, procurement, and revenue. I already referenced operation. We're consolidating 4 facilities. That will all happen in the next 18 to 24 months by the time all those facilities are closed. On the organization side, that's all kind of SG&A optimization, right? We don't need 2 of everything. We don't need 2 sales forces. We don't need 2 HR teams, 2 finance teams, et cetera. So it's all consolidation. Procurement, we're already well onto. That's just, or into. That's just scale and getting the best price from, we're both buying product and services in the marketplace, so taking the best price from each one of the companies, and then obviously applying our new scale. And we've already delivered sizable synergies on that. And then revenue is all about, how do we continue to drive growth in this business? And I'll talk a little bit more detail. $25 to $30 million in synergies. We worked with Boston Consulting Group, who I'd done a lot of deals with in the past to make sure we're well prepared for execution, and now it's about executing with excellence. So we're very well prepared. In fact, we see easily, delivering the upside of that range. Now, a little bit of information in terms of how we're driving a bigger business before we talk better. Maybe just a quick look at that far left, how we perform pre-acquisition. You can see that our growth off of the back of a 16.4% growth last year. We continue to grow solidly in Q1 at 10%. And obviously, we now have the benefit of the acquisition in Q2 numbers, so that's a 74% growth. Underlying growth is about 8.5% if you strip out acquisition. If you look at growth of MCC and growth of DCM, it's about 8.5%, but obviously that revenue growth is 74.7% as the combined company. So really, kind of solid growth over the last couple of quarters, and you can see that we have had 7 consecutive quarters of year-over-year growth. So the market is a good market that we're playing into. We understand how to deliver success in it. We delivered north of $35 million in new business last year. That was as a standalone company. And I'd say the one thing that we're very proud of is we have built a growth-obsessed machine at DCM. We've got, we call VSL, Vertical Strategic Leadership Teams. So we really kind of understand opportunities across each one of our verticals that we play in, those core 8, and we've got 3 other verticals that we're pioneering in as well. And we've identified a ton of opportunities for large enterprises we can bring value to, those large complex enterprises. Having a look at gross profit momentum, you can see that, remember I referenced on the prior chart that our revenue growth, standalone business pre-acquisition, 10% growth in Q1. You can see that our gross profit grew 17%. Always good to see gross profit growing faster than revenue, key metric for us. And you can see our gross profit increase of 57% post-acquisition. By the way, I didn't reference that this Q2 included 2 months of the acquisition plus a week, right? We closed the 24th of April, so the 25th to the end of April, and then 2 months. It was a nightmare for the finance guys to be able to calculate that, but it's 2 months plus a week, so it wasn't a full quarter. So we'll see that full quarter reflected in Q3 and Q4. And we've had 8 consecutive quarters of year-over-year growth on gross margin. Maybe just a quick one on EBITDA, strong start to the year. Obviously, continued performance post acquisition, and more to report on when we report Q3. So we see a clear path to north of $100 million. We're starting with $41 million that we delivered last year. And obviously we pick up the MCC EBITDA of 23.6. Synergies is 25 to 30. And then growth, we've actually modeled quite conservatively. As I said, we are a very growth-obsessed organization. We see a ton of opportunities for growth in this market. We've mapped every single profit pool. We know exactly where to play and how to deliver value. So on the growth side, at the low end, $5.4 million, at moderate 10.4. By the way, for every $10 million in revenue is about $1.4 million in EBITDA. Okay, simple way to calculate it. So that's, even at the growth side of the low end, that's only $36 million in growth. So lots of opportunities for us to continue to deliver growth synergies and even exceed that adjusted EBITDA target in the next few years. On the better side, this is what I was referring to earlier. If you look at legacy DCM, we moved our margin up from 22.7% to 31%. So we've been very focused on driving gross margin improvements. Those are through operational efficiencies, through mix, and really understanding profit pools and how to win in those profit pools and how to deliver value to clients. You can see that obviously with the acquisition in Q2, that 2 months plus a week, you see we dropped because remember 31 plus 20, average out to 25, but we have a clear path to get back to north of 30% in short order, right? We'll do that through operational efficiencies. We'll do it through a mix. We'll do it through pricing. So we'll essentially apply the DCM operating model to the acquired company, which is what we've already started to do. From a headcount, we've had a proven track record. You can see that we reduced headcount by 36% over the last 5 years. Obviously, from 1433 to 910. Obviously, we almost Well, we double the size of our headcount with the acquisition, and we've got a path to take 20% out in the next 18 to 24 months. Already started, as I said, with the announcement of four plant closures. And obviously, proven track record of improving productivity, 33% improvement in productivity last 5 years. You can see we're around 300,000 per head. We see a path easily to north of 400,000 per head in the next 18 to 24 months. And then from a debt standpoint, we got great cash flow in this business, and you can see we know how to reduce debt. We reduced debt by 72% over the last 5 years, and even since this acquisition, we're down 20% post-acquisition since the 25th of April. And you see that on this chart here. You know, the acquisition. This is all in. This is net debt, including cash. We've gone from 126 down to 93.6. So we're down 33%. You can see in here as well. Remember, I said that the deal is $100 million for the business and $30 million for the real estate. We already realized one piece of real estate at $23.1 million. We've got 2 others to move, so we'll easily clear out that $30 million very soon. Okay, so great, you know, focused on debt reduction. Our plan is to get this below 1x leverage very quickly. We're at about 2 right now. I think we're really proud of, by the way, and you know, we talked to all of our clients about this. We're very active in ESG. I won't give you all of our ESG strategies, but one in particular we're very proud of is 100% of our paper use. So 100% of the paper we use for clients, we reforest, and then we allow those clients to use those credits, if you will, through their ESG efforts and ESG communication. So it flows directly through to the client. Most clients actually use those credits. So we have reforested. We entered this program in November, December 2021, so a year and a half. We've reforested 959,000 trees. In fact, as of September, I just got the numbers for August. So as of the end of August, and I just got the numbers this morning, we have reforested 1,007,050 trees. So we're going to celebrate that with a press release, and so we broke 1 million. Pardon me? It's a federal program, yeah, cross country, yep. And the cool thing is clients use a QR code on a lot of their printed materials. They can scan, consumers can scan that QR code and tells them exactly how many trees are reforested for that client. So it's all individualized. So a few closing remarks. We've got a clear 5-year strategy. We see well north of 5% organic growth as a combined company. As I said, it's a very attractive market. If you understand how to win and how to play in this market, it's very, very attractive. Our adjusted EBITDA will be north of 14%. Didn't spend a lot of time on our technology solutions, but we see that being at minimum of $20 million. By the way, it's about $10 million in revenue today, and that's a combination of license fees as well as program management support. But we see that anywhere from 20 at the low end to 50 at the high end. We can see organic growth getting us to somewhere between 700 and 800 million in the next 5 years, which would imply some acquisitions, some tuck-in acquisitions, and then you know, you saw our debt curve. We will deleverage very quickly. Okay, so we do see a path to $1 billion by 2028. A little quick glance at our cap structure. 60 million shares fully diluted. Directors and officers about 30%. ESOP, which is our employees, about 3%. And then we've got a mix of retail and institutional shareholders. So about 177 million in market cap as of a couple of days ago. Okay, so why do I invest, and why do we think it's a great investment? One is our revenue growth is strong. You know, we got a proven track record to deliver success on revenue. We do have that relentless focus on providing enhanced value to our clients. We have a very, very strong operational focus and operational discipline. You know, we sweat our assets hard. Our gross margin, I think I showed you in the prior chart. You know, we're gross margin obsessed, and operational efficiencies we know how to deliver, and we will deliver post-acquisition. We have a very deep leadership team, very, very strong leadership team. I'm very proud of our team. A lot of experience in print, a lot of experience in marketing communication, a lot of big and deep client experience, and we've got a lot of diversity in culture, in gender, and in industry. And then, as I said, from a debt standpoint, we've got proven success in terms of debt reduction, and we're well on track to deliver that 1x EBITDA. And then we've got a lot of comprehensive M&A execution. We've done multiple transactions. I've been involved and been responsible for multiple. We've also done several as a company as well, not as big as this one, but we've done a lot of smaller tuck-ins over the last number of years. So, and we're also very well prepared for what we call world-class execution on a pretty sizable deal. So we're more than confident that these synergies will be delivered, and we're well on path to deliver them. Okay? So that's it. I think we're exactly on time for Q&A, right? Okay. Yeah. Yeah, so I'll answer the first one. Our biggest competitor in Canada was the company we bought. Okay, and then there certainly are some other competitors in the space. There's Transcontinental, who's the largest printer in Canada, although we provide kind of different solutions in Transcon. There's only a little bit of overlap. And your question about the U.S., we already have a business in the U.S., but roughly 4 or 5% of our business in the U.S., very small, and it's from a couple of large financial institutions that have branches that we provide that workflow through to their branches, as well as their private wealth advisors. And then part of the acquisition came with some U.S. presence as well on, won't bore you with the details, but kind of large format packaging. And we've actually acquired, part of the acquisition, we acquired salespeople there as well. So it's certainly a market that we're intending to be a little bit more intentional on. But the Canadian marketplace, we know how to play, we know how to win, and we want to, certainly stay focused on that. We don't want to get too distracted with the U.S., but there's definitely opportunity there. Okay. Yes. Microsoft Vista? No, I mean, we're a Microsoft partner. We're an Azure partner. So we've got a lot of deep experience working with Microsoft. Yeah. Well, Quebecor is, I guess indirectly one of our competitors, right? So, yeah. I don't know. We don't necessarily have any direct relationship with Quebecor. No. Okay. Our largest vertical is FI, and that would be roughly post-acquisition, let's just call it 20% of revenue. And then it's all kind of spread 8-10% across there. Yeah. James, you want to answer that? The question is, why is our stock just so cheap given the future EVs? I guess listen, you guys know what it's like. You got to get noticed. You got to get remembered, right? And that's why we're here, to get noticed and get remembered. I think we've gotten noticed as a result of the acquisition, and our stock moved from, I mean, when I joined, it was 60 cents. It moved to $1.30, kind of hung around $1.30, $1.40, $1.50. Post-acquisition, got to north of $3. We did a capital raise at $3 because we want to bring some institutional investors in. And I think it's just, delivering continuity of performance now and delivering results. Yep. Yep. Great question, though. One more? Well, less than 1 times leverage. And then we want to be, I mean, ideally, get to a point where we can start, turning dividends back to shareholders. That's our plan. Yeah. Okay. I think that's it. Thank you.